And now, back to America's Wealth Management Show. Dean Barber and your local advisor, Dan Fisher.
All right, ladies and gentlemen, welcome back. This is America's Wealth Management Show. I'm your host, Dean Barber. It's time to join Dan Fisher. Dan, of course, has been helping people who are retired or nearing retirement for the last 28 years. He is a registered financial consultant. He's also a registered investment advisor with his own firm, Fisher Financial Group in Chicago. Dan, it's such a pleasure to have you as part of America's Wealth Management Radio Network, and welcome to the program.
Thank you, Dean. It's great to be here.
Dan, we're talking today about year-end tax planning strategies, and all too often what happens is we see people who compile all their information at the end of the year. They take it to their accountant in February, March, and they say, okay, here's what happened last year. How can you help me? You and I both know as professional advisors that that's the wrong approach. That's why we have to start now, right after Labor Day. This is our last shot at the end of the year here to get everything in line. So we've talked about recharacterization of Roth conversions that might have taken place last year. We've talked about tax loss harvesting. And we talked in the last segment a little bit about how people, if they start looking at their 2012 and 2013 and 2014 incomes during retirement, that there are ways that people can reduce something called their provisional income to allow their Social Security to come to them without taxation. Most people don't take the time to do that. They don't understand it. A lot of advisors don't understand it. And the CPA's job is not to help put that together. The CPA's job is to report on what's happened. So let's talk about how people can control that provisional income, Dan.
Yeah, absolutely. Just a little bit of background. It really depends on how much income people have from other sources. They may actually have to report up to 85% of their benefits on their 1040 and pay the resulting federal income tax hit. Well, when this happens, you're effectively getting taxed twice on the same dollars. The first time is during their working years, and then you pay federal income taxes on Social Security taxes that are taken out of your salary or self-employment earnings. The second instance occurs later on when you have to pay federal income taxes on your Social Security benefits. And to make matters worse, depending on where you live, you may suffer the double taxation fate under your state income tax rules too. So while this is unfair, if not downright scandalous, it's pretty much par for the course in the tax world. But there are ways to do that, and it's basically just making some adjustments and things that you can control.
And one of the things, Dan, that we look at oftentimes is something we call a sequence of withdrawals. It's the order in which people take income from their different accounts. And a lot of people might think in the listening audience that, well, you just spend the interest off of your money, you leave the principal intact, and the problem with that strategy is that all of the interest that you pull off is going to be taxable, whether it's from an IRA, a 401k, a joint account, no matter what it is, and even tax-free municipal bonds are included in what's called this provisional income. So, while that is a simplistic strategy, it's not necessarily the best strategy. So I think what the listeners need to do is understand that they need to think about their money in terms of they have a bucket of money. And inside that bucket of money, there's some principal in there. There's some interest in there. There's some tax-deferred interest in there. And if you could reach into that bucket and just pull out the most tax-efficient part of that money first, that's the way that you do it. So if you pull out that taxable, that money that's already been taxed, that principal, and leave everything else inside that bucket, you're effectively pulling out the same amount of money. It's just which portion of it you pull out that controls whether you're taxed or not. So in other words, we could have incomes of $70, $80, $90, $100,000 of spendable income, money that can be deposited in your checking account and still not trigger the taxation on Social Security.
Absolutely. There are so many different ways that people can help themselves, and we can advise them in how to control, the taxation on their Social Security. There's just so many ways, and really, Dean, it's all about putting a good plan together that makes sense, and looking at a person's situation and, just sitting down one-on-one and figuring all this out.
Folks, controlling taxes in retirement is something that you have the unique ability to do. Dan, I've heard people say many times that investments are a matter of opinion and taxes are a matter of fact. And the fact of the matter is that taxes can be controlled in retirement, unlike during your working years, which is why, ladies and gentlemen, we've put together a great white paper just for those of you in the listening audience who are within 5 years of retirement or already retired with at least $250,000 of investable assets. The title of the white paper is called Tax Reduction Strategies for Retiring in 2011 and Beyond. You can get that on our website at americaswealthmanagementshow.com. That's americaswealthmanagementshow.com for your free report, Tax Reduction Strategies for Retiring in 2011 and Beyond. If you want to just pick up the phone and call us, you can do that as well. The toll-free number is 877-500-0350. That's 877-500-0350 for your free report, Tax Reduction Strategies for Retiring in 2011 and Beyond. You're listening to America's Wealth Management Show. I'm Dean Barber, your host, along with Dan Fisher. He is the president of Fisher Financial Group in Chicago. Dan's got an accounting background and has been helping people in the retirement era for over 28 years. Dan, let's talk about one of the biggest assets that people have. It's their Social Security benefit. We talk about the taxability of their Social Security benefit, but people need to understand that there's ways that they can maximize their Social Security benefit through properly understanding their claiming strategies. Can you talk about that for a minute?
Sure. It's all about, first of all, pulling out the statement that you normally get. Usually you get that about 3 months before your birthday. And just taking a look at that, I call it auditing your Social Security statement, and really just making sure that all of the income amounts are correct. There's some people out there that actually have reported Social Security benefits that are wrong. Their income amounts are wrong. So that's actually a period of time that you can actually audit that. So that's one step. The next step is to see, well, when should we start taking Social Security? Well, that's what we do, is because all plans really revolve around Social Security benefits. Pensions, IRAs. This is something that is that was given to us by the government. So we may as well base our planning around that. And it's not a matter of just taking the money at the earliest opportunity because you think that, Social Security is not going to be viable. It is going to be viable, at least, for let's just say, us baby boomers or plus. So it's really, sitting down and taking a look at that and making sure that it fits in with an overall plan.
Yeah, you're right, Dan. And the interesting thing about Social Security is that a lot of people, when they start thinking about their Social Security benefit, they're thinking about me. How do I do it? How do I do it? Right? What do I get from this? Well, when you think about Social Security planning, you especially if you're married, you can't think about it as me. You need to think about it as we, us, ours, because the combinations that a married couple has in choosing their Social Security benefits are enormous. There are 9 different claiming strategies for a married couple, ladies and gentlemen, and those 9 different claiming strategies have to be measured against all claim ages. Let me give you an example, Dan. This is just an example that we ran into here last week. A gentleman turning 62 this year, his wife turning 59 this year. He's eligible to start receiving about $1,800 a month in Social Security at 62. His wife's eligible for $650 a month at 62. Well, when we ran through all 9 claiming strategies and we measured it against all claim ages, what we found was that the difference in total Social Security benefits for the same couple through the same exact life expectancy, when we measured the worst claiming strategy to the best claiming strategy, was $145,000. That's $145,000 of their own money that they no longer have to spend. Dan, that's huge.
It is. It's great. It's a big amount.
And if they don't even have to spend their own money, or they could actually spend that additional money, or they could say, no, you know what, I'm going to take that and I want to pass that down to my beneficiaries. But we're talking about, ladies and gentlemen, is something that's unique. You're not going to hear a lot of advisors that are talking about this. You're not going to run into a lot of advisors that understand it. And if your financial advisor, folks, isn't talking to you about these 9 different claiming strategies and how to measure it against all claim ages, it's time you find a different advisor. Dan Fisher, he's part of America's Wealth Management Radio Network in Chicago. So if you can hear our voice, Dan Fisher's close enough for you to do this analysis for you. He will do a free analysis, run this calculation for the first 30 callers right now that are within 5 years of retirement or already retired with at least $250,000 of investable asset. Don't make the mistake, folks, of not knowing what's at stake when it comes to claiming your Social Security benefits. Call 877-500-0350. That's 877-500-0350. This is America's Wealth Management Show. I'm Dean Barber along with Dan Fisher. Dan, enjoy the rest of your weekend.
Thank you. You too, Dean.